The 1980s were tubular. Big hair, fishnets, Rubik's Cubes, Chernobyl, candy bracelets, the federal disregard of the AIDS epidemic, the war on drugs, and video game arcades were all the rage. Video games were going through a digital revolution. Gone were the bogus sticks and circles of Atari's Pong, and in came a bitchin' yellow circle that ate smaller circles in Pac-Man.
Many cities have reacted by making the arcades off-limits to all under 17 from 8 to 3. This is the after-school rush in Oakland. Long hours at the screens, psychologists say, can lead to extreme introversion, youngsters communicating in a video fantasy land and not with their peers or parents.
One gnarly retail store called Babbage's began to sell strictly video games. This company went through multiple name changes and ownership as it grew higher and higher in value, until finally it became independent in 2004 and was known as GameStop. GameStop became the video game retail store. The missing piece here was GameStop started as a physical retail store at the same time digital music media and MP3 players were growing too. In another 10 years, digital sales of music, movies, and video games reigned supreme. The days of GameStop as a physical retail store were ending. So certain was its path to failure that Wall Street investors began to invest in the failure of the company. Then came the power of the internet, specifically Reddit. Even more specific, a subreddit called Wall Street Bets, dedicated to a group of anonymous users equally invested in stock market advice and mocking the system. This mix of pop culture, politics, and frustrations in our economic system reached a head as more amateur stock traders clashed with a major hedge fund called Melvin Capital that bet against GameStop. These Reddit investors started to buy GameStop stock as well, causing the value to rise. Then the media caught attention of this.
Short interest in GameStop.
This GameStop situation is the craziest I think I've ever seen.
We have some breaking news right now on what has turned into the soap opera and saga of the markets right now, and that is the story of GameStop.
Causing the price to rise even more, to the point where the professional Wall Street investors who lended out the stock at $10 a share now saw the price skyrocket to $400 a share. This exclusive club of Wall Street investors were having their own rules now used against them. Never before had a group of amateur investors taken on a hedge fund like this and won. The David versus Goliath of our time, as told through memes, showing the true power the public has to also create their own value, dictate the rules, and possibly make a buck in the process. Hey everyone, welcome to our 8th economics lecture, investments and the stock market. Today we'll be looking at what the heck investing means, why people invest, what is the stock market, and why it's considered the main factor to getting rich and losing a whole lot of money. But let's go back to our budgeting ideals. A long time ago, in a Zoom class far, far away, we discussed budgeting. And the 50-30-20 rule claims that your income should be spent 50% on needs, 30% on wants, and 20% on saving. We learned opening a savings account with a commercial bank or credit union might yield a 0.5% interest rate. Many of you said, "That's it? Not enough." This is where investing comes in. So with the money you are not spending, it is best to do one of two things with it. 1, save it. 2, invest it. Investing is using money saved to earn more money. Businesses and the government need more money to fund projects, so what they say is, take a chance on me. If you give me money, over time I can give you more money back. This is what we call securities. People invest in securities, which are tradable assets that have money value, like stocks and bonds. So before I get ahead of myself, what the heck are bonds and stocks? So let's start with a simple child, bonds. Bonds, they're basically IOUs governments and companies use to borrow money from people. You are lending a company or a government money and they are paying you back with a fixed interest rate. This time, the government is asking you for a loan. For example, say San Francisco wants to create more housing for homeless people. but they don't have the money in taxes. What they can offer is bonds. You would buy a bond for $1,000 with a 5% interest rate over the course of 10 years. So each year the government is paying you back $50, and then once the bond reaches maturity, in 10 years you would get your initial $1,000 back. So the advantages of the bond is you are being paid while the government holds on to your money, and with a government bond you are guaranteed to get that money back. It is a safe, secure investment. But as many of you might be asking, yes, but how can I make more? Enter stocks. So, what is a stock? Let's pretend now that you own a business. You sell lemonade. You want to expand your lemonade company by opening up another location or by expanding your menu to also include meatloaf. But you don't have the funding to do this. Now you can wait till you make enough profit to expand your business. You can take out a loan that you'll then have to pay interest on, or you can offer stocks, pieces of ownership in your company for a price. People are now paying for a share of your company and are being paid back in dividends, which is a sum of money that the company offers for how well it does each year. As your lemonade stand continues to profit, the demand for your stock increases and the price of the stock increases.
Jill is the smartest girl in the whole world, and I know this lemonade stand thing is gonna be huge.
So, he offers to buy some shares from one of the original investors for twice what she paid for them. He's thinking,
If Jill keeps this up, I can sell these shares for even more later on.
that's the stock market. It's people buying and selling tiny pieces of companies based on how much they think those pieces will be worth in the future. Except in real life, it's happening thousands of times a second, all over the world. There are stock markets everywhere.
Unlike bonds, stock value is in flux and dependent on the profit of the company. So your business can be $70 a share, like Zoom shares were in October 2019, then depending on how in demand your product is, rise to $400 a share, like Zoom shares were in October 2020. The risk about stocks is that you are now owning a piece of a company, and that company could rise or fall based on so many uncontrollable factors, like introducing a new product, controversy over spokesperson or a CEO, a shortage of resources due to a season, the unionization of a company, or speculation about any of the above. For example, when Elon Musk went on Joe Rogan's podcast and smoked weed.
So is that a joint? Or is it a cigar?
No.
Okay, so it's like pot tobacco posh.
You never had that?
Yeah, I think I tried one once.
Come on, man. You probably can't because stockholders, right?
Tesla stock dipped 9%, with two executives announcing that they were leaving the company. This small act impacted the shareholders of the business. Some panicked, then causing a further panic. If a corporation starts to become less in demand, the value of the stock goes down. If it goes out of business, you lose your investment. So a few more things you should know about stocks. This might interest you, this might bore you. For some, this is not enough. But see this as an introduction. A lot of the stock market depends on this gatekeeping vocabulary, and if you understand the basics, you'll do okay. People buy and sell these stocks in a stock market. The biggest ones are the New York Stock Exchange and NASDAQ. What's the difference? The NYSE is an actual physical location on Wall Street where stocks are already set at a certain price, then they're auctioned off. In NASDAQ, it's all digital. There is no physical market and they're traded between anyone who wants to make a deal. For a company, the NYSE costs more to be part of. There's an initial fee around $200,000 just to join the club. Then you have to pay annual fees of around $100,000 a year. NASDAQ costs $60K to enter and around $60K annually too. Most people buy and sell stocks through a brokerage company. They employ stock brokers to help investors make decisions. These stock brokers get commonly a brokerage fee and commission around 2% of managing any client's assets. So say you're a broker and a client wants 100 shares of a company priced at $40 per share. That comes out to $4,000, and you as a broker get $80 just for making that transaction happen. A business first offers stock as an IPO. This is an initial public offering, but the only way to access an IPO is if you already have a certain amount of investment in stock or, of course, work in Wall Street. So, brokerage companies, not the individual, get the first taste of IPOs. This is critiqued as unfair because then those who can access an IPO can then sell their shares at a higher price. Think about when tickets go on sale for
Beyonce.
Then they're eaten up and resold at higher prices. The same with stocks. This bank determines how much the company is worth. The bank then suggests how many shares to offer. But ultimately, it's up to the company. For example, a company whose value is estimated at $100 million may want to issue out 10 million shares at $10 per share. Or they can do 1 million shares at $100 per share. The question is, how accessible do you want your company to be? Finally, there is a term for a full basket of stocks. We call these funds. There are index mutual funds and exchange traded funds, or ETFs for short. Basically, if you invest in a fund, you are not investing in just the financial wealth of one company, but multiple. This is considered a safer investment, since now even if one egg in the basket spoils, the rest could be doing great. We call this diversifying your portfolio, investing in different companies. But funds already package that up for you. These are considered sound investments.
Simply put, index funds are built to have a similar performance to that of a major market index. This means they tend to be diversified in securities across that index and include a number of investments. There are many market indices and index funds that follow them. For example, if you want to invest in US stocks, you might invest in a fund that tracks an index like the S&P 500, which follows the 500 largest stocks in the market.
And the whole process is hands-off. You buy it and let it do its thing. This is considered passive, where you live your life and your index fund accumulates wealth. They can only be traded once a day. ETFs also take a portion of the market and its value and bundle that up, but they can be traded multiple times a day and are more easily converted to cash at any point.
If an index fund and a stock got married and started a family, their children would be ETFs, exchange-traded funds. ETFs have inherited traits from each parent. Just like index funds, most ETFs are passively managed, diversified, and low cost. And just like stocks, ETFs are bought through a brokerage account and trade on an exchange at any time during the day. This mashup of desirable traits has made ETFs increasingly popular investment tools.
So what's the point of knowing all of this? We have discussed budgeting, financial aid offers, loans, resume tips, taxes, but investments ask, what do you want to do with your future? When you have money, how can you use that to secure more money in the future too? How can you make a financially stable retirement plan? People want to ensure they have money as they get older. The best way to do this is to open up an individual retirement account, or an IRA. This is commonly done through traditional IRAs, Roth IRAs, or rollover IRAs. Remember, this is just a type of account. It's not saying that it has any type of stock involved. There is no age limit to contribute. You can start one right now. So first, the traditional IRA. With a traditional retirement account, you make contributions that are tax deductible throughout the year. Any earnings you make are not taxed until after you pull that money out. You can only put in $6,000 a year, and there is a 10% early withdrawal penalty if you try to put that money in your bank account prior to being age 59 and a half. Some exceptions are a first home purchase, a birth, adoption, and certain college expenses. With a Roth IRA, you're paying taxes with whatever money you contribute, but you are not taxed for any earnings or after you pull that money out. So here are the similarities and differences between a traditional and Roth IRA. Third up, a rollover IRA. You are taking money from an employment retirement account like a 401k or a 403b and rolling that over in an individual retirement account in order to use.
If you change jobs over the course of your career, it can be easy to lose sight of your retirement accounts with previous employers. That's when a rollover IRA can help. A rollover IRA is a holding account for funds from previous employers' retirement plans. In a rollover IRA, you roll over or consolidate retirement accounts from past employers into one centralized account.
So employers can offer two different types of retirement accounts already set up for you, meaning they're already taking some of your income and putting that away for retirement. First, the 401k. This is for private, for-profit businesses. You can decide to have up to $19,000 to be put in your 401k a year, and your employer or the company you work for can match that amount in a contribution to your retirement account too. This is the beauty of a company offering you a 401k. They are taking a portion of what you earn, and that company is adding more into your retirement account for you as well. With a 403b, this is strictly for government jobs or nonprofit organizations. However, it's more rare for a government to match the amount in your account. Still, you have a portion taken aside that is earning income for you. You cannot touch either until you're at least 59. If you open your own account, you can either choose for yourself what you want to put into it, or you can have an online broker do it for you.
Once you've funded your account, the robo-advisor continuously monitors your portfolio. As the individual assets in your portfolio rise and fall along with the market, robo-advisors will look for opportunities to buy or sell investments.
The last question I want to address is, how do you know what you're investing in is a good investment? This is when good has nothing to do with morality, but what strictly benefits you. There is no get-rich-quick scheme. If you're going to invest, play the long term. Keep your money in there for 5, 10, 15, or 20 years. The average healthy amount your investment grows is about 10% each year. People wonder, well then what companies are exactly secure? There are a few ways to answer that. The first is through a credit rating. Investing in a low-risk company means investing in a stable business. Investors choose what bonds and stocks to buy through rating companies. A high-quality company is lower risk. It has a AAA rating. A lower quality company is higher risk with a BB or C rating. So, what determines that rating? The rating company itself. This is a highly subjective process, and the judgment is based on credit quality history. Does a business timely pay off loans? Is it financially thriving and free from debt? This became a disastrous process leading up to the stock market crash of 2008.
Not in generations has Wall Street absorbed the number of body blows it took today.
The American financial system is rocked to its foundation as top Wall Street institutions topple under a mountain of debt.
When you step back for just a moment and consider the events of the last few days, it is truly unbelievable.
It was the perfect storm of banks, Wall Street investors, credit rating companies, and the people doing things that they shouldn't. So, Wall Street investors could buy debt. They can buy debt from any type of loan, including student loans and mortgages. Their incentive to buy debt is because they get paid interest as you pay off that loan. So investment companies begin to invest in mortgages, loans for people's houses. Banks saw this as a win-win because while they may make the initial mortgage loan offer to people, hey, they don't have to be the ones to collect it. Some investor bought it off of that bank. So banks started to offer big loans out to people without certainty that people can pay for this mortgage. You had individuals with part-time jobs owning multiple houses because the bank said, we will offer you loans for these houses, but they weren't being paid off. But the higher the loan, the more investors wanted. And those who saw bad credit ratings for mortgages, they tied them up together, like those mutual funds, into a basket called a CDO.
A CDO?
Yes.
A CDO.
What is that?
This is where we take a bunch of Bs, double Bs, and triple Bs that haven't sold, and we put them in a pile. And when the pile gets large enough, the whole thing is suddenly considered diversified. A collateralized debt obligation. It's important to understand because it's what allowed a housing crisis to become a nationwide economic disaster. Here's world-famous chef Anthony Bourdain to explain.
Okay, I'm a chef on a Sunday afternoon, setting the menu at a big restaurant. I ordered my fish on Friday, which is the mortgage bond that Michael Burry shorted. But some of the fresh fish doesn't sell. I don't know why. Maybe it just came out halibut has the intelligence of a dolphin. So what am I going to do? Throw all this unsold fish, which is the triple B level of the bond, in the garbage and take the loss? No way. Being the crafty and morally onerous chef that I am, whatever crappy levels of the bond I don't sell, I throw into a seafood stew. See, it's not old fish. It's a whole new thing. And the best part is they're eating 3-day-old halibut. That is a CDO.
So these CDOs had high credit ratings when really it was a piece of poop clumped together with other pieces of poop sold back to individuals as gold. The credit rating companies claim that they gave these outstanding debt mortgages a good rating because if they didn't, they would lose business from the banks and the other credit rating competitors would rate them high. Competition and greed outweighed any ethics. When something is valued at a higher price than it should be, we call this a bubble. This value keeps going up and up based on excitement and speculation, but eventually this bubble has to burst. What ended up happening is people defaulted on paying their mortgages. There was no real money to be made. Those Wall Street investors and banks now bought something that had no real value. And once that realization was made, they ended up in debt and then hurt the retirement accounts, employment, and housing of millions of Americans. The Great Recession. 9 million workers lost their jobs and 10 million people lost their homes. Not to include the millions of people who saw pay cuts or devalue in every investment they had. You were all alive. Ask your families about their own experiences through the Great Recession. And I explained just a portion of this story because while the stock market has become this symbol of free market economics and wealth, we are playing with people's lives. There's this patriarchal frat boy culture that still reigns supreme in the one place that we're all told this is what you have to invest in to keep your family safe. And yet it is in the hands of the riskiest people.
More big-name companies made plans to shed workers.
A bank that got billions in free money from the taxpayers then turns around, cuts off credit to a local business, and then won't authorize workers to get a penny upon leaving with 3 days' notice. We're outraged.
Bail out working women and men who worked hard to buy their homes. That's why we say, not Wall Street, but Main Street.
And one of the scariest parts is college debt is also a bubble mimicking the same outcome as the housing crisis in 2008. Investment banks are buying massive amounts of college debt in the hopes that it is paid off, but that debt just continues to grow. So, what can we do? You're getting out of high school at an unstable time where businesses are hiring and trying to bring back profits again. A few tips if you have the means and want to invest. Number 1, create a retirement account right now. I would recommend a Roth IRA simply because you can touch at least the money invested after 5 years. E-Trade, Ameritrade, and Fidelity all offer free accounts with no minimum. But if you want some service to create a diverse portfolio for you, that could come at a certain percentage fee. Also, please know in order to create an individual retirement account, you're going to need some actual income to put in. Number 2, invest in mutual funds or ETFs. It depends on how or when you want to actually touch that money. So if it's common, go for the ETF. If you want to leave your investment alone, go for index mutual funds. Remember, this is a collection of value within the stock market, not any one company. Number 3, if you want to make money, be in it for the long haul. Keep your money untouched for years. Do not think short term. Think about your investment as a long-term investment. Finally, investing in the stock market is where many of us are forced to compromise our own values for the sake of our future. We may not agree with a company's business practices, but they bring profit. Becoming a shareholder is one way to use your input within a company too. Or just invest in companies that do share your same values as well regarding, say, sustainable energy, labor unions, etc. You have power. And just remember, in the midst of all these arrows and numbers, this is not a game. There are families and their futures depending on these investments too. Thank you for watching. Godspeed.